Recording in progress.
Hi, good afternoon, everyone. Thanks for joining in for the webinar. We'll start very shortly as we allow more participants to stream into the session first. So around 12:01, we will start the session. Right, so do kindly wait for us. So later on the session, if you have any questions, do put them in the Q&A box itself and not in the chat box. So Q&A box for any questions that you might have, and we'll answer the questions at the end of the session. Yeah, thank you. All right. Thanks everyone for joining us this afternoon. All right. So thanks everyone for joining us on a Friday afternoon. I hope everyone have a great week already. Okay. So for today's session, we have two speakers. Today we will have a speaker from SGX Group. We have Miss Vanessa Ong with us. We will share more about the SDRs first. Before I will share also on the Hong Kong market and also on the 5 counters that we have in the new SDRs. So without further ado, let's start with Miss Vanessa Ong. Thank you.
Okay, hi everyone. My name is Vanessa, and together with Venice, we are the product managers of the SDRs or the Singapore Depository Receipts. So, for those of you who are unfamiliar with what SDRs are, we have this slide over here that just summarizes the key differentials. So, an SDR essentially represents a beneficial interest in an overseas security that is listed on a foreign exchange. So currently, we have SDRs ranging from underlyings in Thailand as well as Hong Kong. And from the SDRs, investors can receive dividends and cash distributions as they would from a typical security listed overseas. Now, there are 3 key differences between the SDR and the overseas share. So the first difference is the lower cost that is associated with the SDRs due to the lower brokerage fees and no FX charges as compared to an overseas brokerage charge and FX fee that you will incur if you were to buy the share from Thailand or Hong Kong directly. Additionally, one of the key differences between the SDR and the overseas share is the additional convenience that is associated with it. So on the SDRs, it actually trades on SGX in our trading days and hours, and it's also traded and settled in SGD as compared to being traded in a foreign currency with an additional FX fee applying. And lastly, one of the main differences is that the SDRs are custodized with CDP and is visible with all your other SGX holdings as compared to being custodized with an overseas broker. So recently, we launched a Thai SDR suite last year as well as this year in April. And we have seen the Thai market rebound in the recent quarter. So from the graph on the left, you can see in 3Q that the SCG50 has returned about 12 to 13% in 3Q, which outperformed all ASEAN markets. Now, this general pickup in pace has been driven by 3 structural factors. So firstly, we have the US Fed cuts, which narrowed the interest rate differential between US and emerging market assets like Thailand, which correspondingly made Thailand much more attractive. Additionally, we also saw greater political certainty following the appointment of Thaksin as PM, who replaced Srettha, who was previously dismissed for wrongfully appointing a cabinet minister. So this actually signaled greater political continuity and economic certainty for Thailand, with one example being the digital wallet handouts, which injected around 500 million into the economy to support Thailand's recovery. And lastly, we also saw the launch of the Thai state-controlled Vayu Pak Fund, which congregated around 6 billion of inflows from retail and institutional investors to boost the local stock market. Now, this fund is highly unique due to the fact that it guarantees a high minimum return of 3 to 9% over the next 10 years, which could sustainably reverse this trend of institutional net selling that we have been seeing in the Thai market. So on the back of these 3 structural factors, we have also seen that the Thai SDR suite, as highlighted on the right, have delivered strong price performances in the last 6 months. Now, the light gray line on the right highlights the Thai benchmark SCG50 returns. And we can see from the other lines that the majority of our SDR suite has managed to outperform the Thai benchmark, returning about 27 to 50% in just 6 months. Furthermore, we also see notable counters like AIS and Gulf, as highlighted in dark blue and in yellow, trading to multi-year highs. And lastly, a slight exception among the SDR suite is this counter in dark green, PTTEP, which was on a slight downtrend due to the fact that it moves in tandem with oil prices that was on a slight downturn this year. But even despite this downtrend for PTTEP, it still managed to outperform that of oil due to its high dividend yields of more than 7%, which offset the price decline. Additionally, last year when we saw that the Thai market was not performing as well, we also saw PTTEP outperform the Thai benchmark and serve as a strong portfolio diversifier to balance investors' overall portfolio. So overall, you can see that the Thai SDR suite has delivered strong price performances this year, with certain counters like PTTEP also serving as a strong diversifier to balance your overall investments. So on the back of this strong performance in the SDR Thai suite, we have also seen that turnover growth has managed to double in the last 6 months. So from the graph on the left, you can see that we actually launched 5 new Thai SDRs this year in April, and the majority of this turnover growth has been contributed by these 5 names. So the most popular Thai names we have currently is KBank and Delta, as highlighted in dark blue and in light blue. So KBank is popular due to the strong investor interest and familiarity with banks in our market, whereas for Delta, we generally see higher price volatility and a wide trading range, which makes it suitable for active trading among our retail investors. And lastly, from the right, we also see that from a holdings perspective, our 5 new names have accounted for a majority of these holdings and have been well received by investors. With similar names like KBank as highlighted in dark blue, also accounting for around 1/4 of these holdings. So overall, you can see that the Thai SDRs are popular in terms of turnover, as well as among the buy and hold type of investors from a retail AUM perspective. So on the back of this strong interest in our Thai SDR suite, we're now excited to announce to you that SGX, together with Phillip Securities, has recently launched a new batch of SDRs on 5 Hong Kong underlyings for the first time this year. Now, these 5 Hong Kong SDRs represent the 5 mega cap stocks in the Hong Kong market, including Alibaba, BYD, Tencent, HSBC, and Bank of China. Now, these 5 names cover more than 30% of the HSI index and represent 3 key sectors, including the financials, technology, and consumer discretionary sector. So SGX has also carefully created these 5 names based on the feedback and the data points that we gathered from our first 2 batches of Thai SDRs. So one example is how we are launching not just 1, but 2 banks like HSBC and Bank of China on the back of investor interest in KBank. Additionally, we are also launching 3 exciting China mega cap tech names, which have similar or even more exciting profiles than Delta. Also, these 5 underlyings are also the top traded DLCs and structured warrants that we currently offer on SGX, which allows investors to complement their existing portfolio of Hong Kong and China-based products on our platform. So some of you may be wondering, okay, these 5 Hong Kong names look exciting, but why should an investor choose an SDR versus just purchasing the share overseas? So the first proposition of the SDRs, as highlighted on the right, is the additional convenience that is associated with it. So currently, we actually have a suite of China and Hong Kong-based products on SGX, including the ETFs, DLCs, and structured warrants. And now with SDRs, investors can conveniently manage their existing China and Hong Kong-based products all on a single platform on SGX. So one example is how you can maybe use the DLC or structured warrant to gain leverage exposure to a China-based underlying by purchasing the Hong Kong SDR. Additionally, as highlighted on the left, one innovative feature of our SDR suite is also the increasing affordability that we offer to investors due to the bite-sized investment amount. So one example is how BYD in Hong Kong, if you were to purchase it, you would have to deploy a major capital outlay of more than 25,000 just to gain access to it. But with our SDR suite, you can gain access to BYD from just as little as $500, which is less than 2% of the investment outlay in Hong Kong. So as you can see, the SDRs does increase the affordability for investors substantially. Furthermore, one of the nature of the SDR suite is the cost effectiveness associated with it due to the lower brokerage fees and no FX charges for the investment products listed on SGX. And lastly, other than the convenience and affordability of our SDRs, our SDR suite also allows investors to flexibly position for overseas news flows, especially for the Hong Kong and US opening. So SGX actually trades ahead of the Hong Kong market opening timings at 9:30 a.m. And we also overlap with that of US pre-market, which allows investors to use the Hong Kong SDR to position for overseas news flows in Hong Kong as well as US. So on this point of greater flexibility and positioning for news flows, one example is also how the Hang Seng Tech ETF traded on SGX. So on 8 October at 10 a.m., post the Golden Week holidays, the China government was scheduled to hold a press conference to discuss certain policies aimed at boosting growth. And on that same day, we saw the Hang Seng Tech ETF trade actively both before and after the Hong Kong market opened. So the SGX market, as highlighted in green, opens at 9, and the Hong Kong market opens at 9:30. And within this short 30 minutes window, we saw the Hang Seng Tech ETF generate more than 2 million of turnover while maintaining a wide trading range of 6% to allow investors to position for the news at 10 a.m. Furthermore, on the right-hand side, post the Hong Kong market closure at 4 p.m., we saw this ETF continue this active price discovery and trade more than 2 million of turnover to allow investors to close out their positions or to mitigate some of their risk after the China government announced the policies at 10. So as you can see, there were substantial volumes traded during the pre and post Hong Kong market hours, which accounted for more than 20% of the Hang Seng Tech turnover to allow investors to position for overseas news more flexibly. Furthermore, other than the Hang Seng Tech ETF, we also saw Tencent, which is one of the underlyings for our Hong Kong SDR suite, follow a similar trend to the Hang Seng Tech ETF to allow investors to position for news flows. So for Tencent, it actually recently announced its Q3 earnings on 13 November, which was post the Hong Kong market hours. And its profits actually managed to outperform that of estimates. So on the next day at 14 November, we saw how the SDRs allowed investors holding a bullish view of Tencent to generate greater upside from the Tencent SDR. So on 14 November from the graph, you can see the SDR trade at $6.82 when the SGX market opened at 9. Furthermore, when the Hong Kong market opened at 9:30, the SDR price continued to increase substantially and trade at $6.96 in just 30 minutes. And lastly, at 10 a.m., after the Hong Kong market opened, the Tencent shares actually traded up and hit a high of $7.16 to allow investors to generate an upside of 5% just within a short 1-hour window. So as you can see, entering the Tencent SDR at SGX actually allows investors to take a position on Tencent's opening price on the Hong Kong market and generate upside. So with our existing Thai SDR suite and now also with the Hong Kong SDRs, we now allow investors to express their thematic views across a broader range of sectors. So if you're someone who desires more growth-oriented opportunities, we have sectors from the AI transformation and the EV transition sector. On the other hand, if you desire more value or income-based sectors to generate a regular stream of dividends and income, we also have the financials and supply chain sectors to cater to your preferences. So for example, for the AI transformation sector, you can now tap on the entire AI value chain, spanning the software companies like Alibaba and Tencent, all the way to the hardware suppliers and the infrastructure providers from the Thai SDR suite, including Delta, Gulf, and AIS. Additionally, even for the EV sector, we have secondary listings like NIO on SGX. And now with the Hong Kong SDRs, you can also use BYD to capture more global opportunities across the EV value chain. Furthermore, for the financial sectors, you can position for a range of global interest rate changes, ranging from more globalized exposure through HSBC, all the way to more specialized exposure through China-based stocks like Bank of China, as well as Thai-based banks like Kasikorn Bank. And even for the supply chain-based sector, you can also gain access to some of the top fast-growing companies in Thailand, including Siam Cement Group and CPOL. So thank you so much for listening in on this. In summary, I think the Hong Kong and the Thai SDRs offer investors flexible, affordable, and convenient exposure on SGX. And I'm now excited to pass the time over to Huan Zi, who will be actually going through some of the macro developments on the Hong Kong market. Thank you so much, everyone.
Right, thank you, Vanessa. So I will share the screen on my end to just hand over in a moment. Okay, so my screen should show up shortly. Okay. So before I start the proper content, just to share some promotions that we have ongoing. So we always have this refer a friend promotion. If you have any friends and family members that are not yet account holders of Phillip Securities, can feel free to share your referral link that you can create through the QR code here to make your own make your own unique referral link to share with your friends and family members. Second one is related to promotion on what is actually shared by Vanessa just now regarding SDRs. So right now, SDR is trading at zero brokerage on our Poems platform, as well as there is actually the $15 to $50 cash vouchers they can redeem on the Poems 3 app, P3 app. You can redeem them every Friday, every week, right? So you have to trade a certain value, either 500 or 5,000 worth of the SDRs in order to qualify for the $15 or $50. But this promotion is until end of the December 2024 as well. So you can actually try out to see if you want to get exposure to Hong Kong or to Thailand market through the SDRs. You might actually want to participate in this zero brokerage as well as the this SDR cash vouchers promotion as well. Okay, so we also have extended this market depth access. You can still feel free to actually access and also apply for market depth access. Right, so you can also join our Telegram group for more market update and investment update as well. All right. Okay, so the topic I will touch on today is actually on similar to what Vanessa has shared, that the new SDR offerings is on the Hong Kong market. So we want to share more about the Hong Kong opportunity and growth potential that you might want to look at to see how the Hong Kong market can be relevant to you, as well as maybe you want to see how you actually want to use the SDRs, the Hong Kong 5 counters, to actually add to your portfolio as well. Okay, so outline will be an overview of the Hong Kong and China macroeconomic first before we go to the trends and the 5 counters. All right. So for the overview wise, you can see that Hang Seng actually outperformed S&P 500 in September 2024. Actually, it rose 36% within that month itself. Of course, it retreated more than 16% already from that high level. And right now, the Hong Kong Hang Seng Index is still at a PE ratio that's below the 10 years average of around 10 itself versus the 11.4 10-year average PE. Right. So right now, recently, the recent earnings by the big counters also see upside surprises for the corporate earnings. However, of course, the share price performance was a bit muted due to the macroeconomic condition from the US market as well as the Trump election presidency. And PBOC, the People's Bank of China, is the series of the stimulus measures was the main reason why there was the rally in September, right? So you can see that PBOC came in with a lot of different measures to actually help to support the market, which I'll touch on later, to try to push up the economy, and also the stock market did benefit from that as well. And one of the ongoing concerns that we have for Hong Kong and China market will be the continuous deflationary pressures, as well as the Trump winning the US presidential election might actually have certain headwinds for the Hong Kong and the China market itself. So next, we also have macroeconomic conditions that might actually be facing for this Hong Kong and China market for 2025 as well. Okay, so for domestic factors, right, you can find that PBOC's stimulus measures since late Feb, they actually cut key lending rates. They have liquidity injections through the reserve ratio requirement, the cuts, right, RRR cuts. They also lowered the mortgage rates on the existing home loans. They also asked the regional banks to help support the home purchasers, and also even try to ask them to buy over the housing projects for certain scenarios. Of course, the whole thing is that the PBOC's measures had initially helped to support the market, but thereafter, maybe in October and going into November, people find that maybe it might not be sufficient as of yet. So right now, there's some pullback from the Hong Kong and China market, but they're also pending to see, they are anticipating more actions from not only the PBOC, but also from the China government in order to boost or to support the China economy. So if more measures was actually introduced and also showcased, then maybe we will see a better recovery overall for the China and Hong Kong market, right? So in terms of why there's more measures that we actually anticipate that will come in, is because there's continuous deflationary pressures. We can see that through actually some of the numbers. So there's inflation data that's still a bit weak. There's a weak external demand for the exports itself. The orders itself for their home prices is still contraction measures. So all these numbers actually showcase that China still have certain segments of the economy that is still a bit weak, that needs further stimulus or support to have a proper recovery in terms of the overall nature. However, we also see that some of the monetary policy have already seen success, which is the reason why the government might also continue to bring in new measures, because they already see success in certain measures targeting certain segments of the economy already. So you can see that the stronger retail sales is actually seen, and also there's improving purchases manager index numbers. So for retail sales, how you see that actually there's recovery. Recently, we have the 11/11 that just passed in November. So it was a previous shopping festival, so-called, that was created by Alibaba. But basically, we see that now there's already a lot more recovery in terms of the domestic retail spending for this type of shopping festival, not only for Alibaba, but also for other companies like JD, for Pinduoduo, and also even through TikTok, right? So the general issue that we see that is going to face China and Hong Kong is that there's an uneven recovery across the economy. So there's worries that if the government only leave it to what stimulus they've previously already rolled out, they will actually be fizzling out of this recovery momentum. That's why we believe that likelihood is the China government will actually step in once there is more clarity, maybe not only within the country of China and Hong Kong, but also with the US presidential election, to see what Trump will do once he get into power. Is there any first actions that he do? So that might be also one of the factors that they are looking at before they roll out new measures. All right. So the idea is that there might be needing of a stronger physical policies, and not only through monetary policies that they are currently doing. So if physical policies come in to support the economy, we might see a stronger direct impact into the economy of the China-Hong Kong market, and that might actually stimulate certain retail or the sectors that they are supporting directly. Okay. Okay, so next time we have expectations in 2025 is that China growth likelihood will have a slowdown, right? So this year they expect generally most economies average around 4.8% for the GDP growth. Then we're looking at maybe 4.5% for 2025, and they might actually even looking at 4.3% in 2026 itself. Okay. So for the Reuters poll of economies itself, it shows that the US might potentially impose around 40% of tariff on imports from China from early 2025. All right. Of course, there are talk that saying that Trump might actually push the tariff up to 60%. But in general, most people assume Trump might not go directly to 60% on onset, but maybe they start around 30 to 40% type of a rollout of a tariff, potentially. And this tariff itself might potentially impact growth in China by up to 1%. So let's say 4.5% was the previous estimates. If let's say the tariff was actually more 60% or 70% even, then it might actually push the growth expectation down from China from 4.5 to maybe 3.5%. That's what we mean by 1% of the impact of the growth itself. So as a reference itself, right, the first term of Trump, you can actually see that the tariff imposed was only around between 7.5 to 25%, and that already had a very big impact on terms of the overall sentiments and also in terms of the overall supply chain movement between the market. However, do note that for tariff itself, usually there's a lot of different measures that China can retaliate with, and it might not be directly only impacting China. So if China actually have different measures, like maybe China yuan depreciates, or maybe China support the economy even further, then the impose of the tariff by US might actually roll over and then end up damaging the US consumers more. Because if the US consumer have no other alternative to go into, they might still have to buy the China goods at a higher price, so-called with tariff, and then end up they will have more direct impact to the US economy itself also in terms of inflationary pressures. So next thing is that more stimulus measures, like I mentioned, we are expected to cushion the trade tension with the US. So, and the CPI forecast is lower to 1.1% and for 2025 and 1.4% for 2026. That is actually quite a low inflationary pressure number for China. Because it's below 2%, it's actually showing some form of deflationary pressures across certain segments, mainly in the segment of property and real estate, with reason of the weakness that we see in the real estate sector due to the property developers, all the ongoing issues with some of them. And this ongoing issue of property being devalued or disinflation and everything actually have a negative impact for overall growth in China, because one of the main growth of wealth for citizens or for people in any country, one of them is always on property prices itself. And if China cannot support property prices effectively, then the wealth effect, the wealth growth for the middle and lower class in terms of the citizens in China will have a stronger impact. And that's why the overall recovery growth of the economy will have a slower pace compared to what they previously envisioned. Okay, so one more thing is that what more short-term measures that might be rolled out is that the 7-day reverse repo rate was actually mentioned that there might be expectations that it might be further lowered to 1.3%, a cut of 20 basis points early next year, especially if US actually do cut rate in December. So likelihood the China can also cut their rate on their end. So if the US cut rate and the China cut rate together, then the pressure on the Chinese yuan to depreciate will not be as strong. But China also do not want to directly depreciate very strongly, because they might also want to maintain certain sentiments itself. Because Trump itself and also the US market have always been saying that China is more a manipulator of the currency. So of course, China does not really want a totally weak yuan per se, but of course it might actually go towards that direction if they do want to counteract the impact of tariff itself in future. But that is a weapon that they want to keep on hand and not directly utilize from the onset. Okay, so this is the proposed one of the graphics from Reuters itself, right? So will Trump actually propose tariff be implemented next year, early part? Most of the people that are being surveyed for economists and analysts is actually a proponent of yes, it will be early next year. So likelihood we do see an impact coming into the trade tensions, to the trade relations in early next year. And the most of them, they generally believe to be the level of between 31 to 45%. That is the range that people are expecting in general. All right. So other than that, we mentioned what other further risks we do see in 2025 for China and Hong Kong for the geopolitical and also the macroeconomic. So there's the regional risk that's still ongoing, the Russia-Ukraine crisis. There's some escalation here and there recently. But in general, it's been an ongoing conflict, and the main impact will be because China is a very near neighbor of both countries. So technically, there is direct impact either through supply chains, through the import-exports of certain goods, as well as the impact on the oil prices for Russia-Ukraine. All right, and there's also the Middle East, some of the regional risks that we have over there. Then we also have certain other trade routes that have faced issues recently, right? So all of that actually generally means that the logistics side, in terms of supply chain management, in terms of due to the tariff impact and all that. So all the situation leads to a proponent that like next year we do see a lot of supply chain movement around the world that might actually be channeled either through China moving to Southeast Asia or Southeast Asia moving to other countries due to the network changes effect itself. And in terms of energy sector, we do see that the Middle East and Ukraine conflict will continue to actually impact the oil prices. So there is a lot of volatility that we do see into 2025, even for the China market economy. And China is actually one of the proponents of renewables, right? So they are very strong at investing investing into renewables. So technically, that will also be one of the segments that energy sector they want to reduce their reliance on the traditional energy by through coal or through the traditional oil itself. So China is also still investing very strongly into the renewables itself. And the next thing we have is the financial services, which we do see the falling interest rates that will actually weigh on the bank profits. Later, I also mentioned how China's net interest margin is actually falling due to their monetary policy as well to support the economy. So in general, most of the banks will see pressures on the net interest margins that they have. But on the flip side is that they might have stronger growth in terms of loans to increase the overall demand of their products itself. So in terms of the banks itself, they might increase their net interest income, but have a lower net interest margin per se, right? So in terms of consumer goods and retailing, there's still higher demand. So this inflation actually, even though inflation not being high, is actually bad for economy. But it also sort of stimulate or spur a certain level of demand for consumer goods and retail, right? Because it's cheaper in the sense of either for tourists or even for locals to buy due to the recent the prices. If it stays low, then technically it will be cheaper to buy over long term. But we do see that the regulation might be coming in to actually impact the consumer good and retailing. So either there's regulations on the online e-commerce, regulations on tariff itself from the overseas import everything. So there's different regulation. Even for EU to China itself, there was already a tariff impact on the EV, electric vehicles itself. So generally, consumer goods might see also some volatility. But the domestic consumer goods and retail, I think we believe will still continue to do well due to the demand itself. And for technology-wise, we do understand that across the world, there's a lot of AI push, right? So a lot of companies are moving into AI. So regulatory pressures and energy usage is the main concerns that we do have for this sector, all right? But the continuing investment into AI is definitely going to continue. So companies in China, they have a very strong AI presence in terms of their exposure, in terms of their R&D, in terms of how they're trying to push for their exposure. And we believe this technology sector will continue to do well in China and across the world itself. And for automotive mobile, I believe most of the people understand that China is also moving to EV very quickly. There is so many different brands of the EV vehicles that's coming in from China. And actually, they are also encroaching into the overall worldwide market as well. So we have BYD, you have NIO, you have other companies like Li Auto and all that. So every company that they have in China, even Xiaomi came into the EV business. So overall wise, the EV vehicles is expected to increase by 25% in 2025 in terms of sales in China. So that is actually quite a substantial increase in terms of number. And as I go through the individual stocks expectations, you can actually see how this overall economy factors might actually affect the individual counters as well. So for the first one, the SDR that was mentioned, I think Tencent, all right. One of them is actually Tencent, right? So HTCD is the SDR ticker code in Singapore SGX, all right, the listing, right? So currently Tencent is around plus 39% year to date as of yesterday, and right, not as of today, as of yesterday itself. And for Tencent itself, their AI deployment likelihood will take more quarters to impact the earnings meaningfully. But it also shows that they have been investing very consistently into AI to see how it can help them to be more efficient and be more effective in terms of advertisement, in terms of how they can actually utilize their network itself. So right now, Tencent, the main growth story is still within the online games industry, and they are still looking at fund inflow. within the game sector with the resumption of growth and advertising itself, right? And so for Tencent, usually we are looking at more game releases and what is the revenue growth story for that. And 40% of the operating income currently is from gaming segment. However, they have a very large untapped value through their network products, which is like WeChat, which has 1.2 billion users, which is what we are saying for in terms of how they can utilize AI to actually try to monetize some of the value within WeChat and also in some of the other areas of potential value creation for their Tencent network of industry. So other areas, example being we mentioned like a cloud storage for them. So a lot of people store through cloud in China, right? So in Singapore, also in overseas everywhere. So cloud storage is a very increasing demanded product per se. And with one of the biggest network of WeChat in China, in terms of cloud storage usage utilization, they are very, very easy to tap into that industry because the users directly will just store their data on the WeChat onto the cloud storage directly as well. And of course, other than the cloud storage itself, Tencent also have a different business services type of potential, in terms of mainly through the advertising side, where they can actually monetize their network effect to actually reach out to the stronger advertising revenue itself. Okay, so for Alibaba itself, the code in SGX for the SDR is HBBD, right? So Alibaba is a bit weaker than Tencent, definitely. Right now, year to date, it's only up 11%. So one of the reasons that they have facing issues is that they have been losing market share to like Pinduoduo, to Douyin, or to TikTok equivalent for the international one in terms of China e-commerce for the year. Overall wise, they are at 62%. All right, versus 72% if you compare year on year for the FYN March 2023. So you can see that the numbers have been dropping. For this year 2024, they might see further impact overall year. However, they did see quite a strong recovery in terms of overall retail demand on the 11/11 that I mentioned, right? The Singles Day promotion, the shopping festival. And Taobao and Tmall is still the core cash driver for them, right? And that actually helped to support the investments into AliCloud, which is also one of the main future industries sector that they're looking at because of the AI factor and also the cloud industry demand. And there's a potential downsizing of their low margin business, so they can try to redirect the funds that they have to the more higher profit margin level. And they can also, after they redirect the funds and capital, they might also return certain funds to investors for divestments. So instead of only reorganizing their business, they might sell certain non-performing business. Right. So we also see that for Alibaba, they had a recent news update where they actually announced that they will be combining their e-commerce, the domestic and international segments into one. So the TTG, which is the Taobao and Tmall group, the sector, will actually combine into one to a single business unit for the international and domestic sales revenue itself. So in that sense, it might actually help them to actually streamline their operation and cut costs, and also increase their competitive advantage in terms of the sales. And it's been already showing because the international sales have been increasing after the recent new leadership changeover over the past 1-2 years. So there is certain bright spots in Alibaba that they can still do well in e-commerce after they shift their strategy slightly compared to the past. So for Bank of China, we have a HBND. This is the counter code for the SDR for this trading in SGX for the Bank of China. So Bank of China itself up year to date is up 23%. All right. So the quarterly profit that they announced was around 4.38%. So they actually they are actually finding a squeeze in their margins, like I mentioned. So in terms of government policy that come into play, the monetary side, where they cut different interest rates, requirement ratio, everything. Even though we release a lot of funds to the bank to lend out, but it also cut or squeeze in terms of how much the bank can earn for the net interest margin. So it has dropped to 1.41% as of end of Sep, from end of 1.44 end of June. So if you compare that actually a drop of 0.03%, and it might continue to drop if there's more further stimulus measures coming in that will actually cut or impact the rates itself. And we do see that the overall interest rate environment is actually going to be on the lower end going forward after the US cut rate also for December, if they do continue their rate cut cycle. And the non-performing loan ratio is at 1.26%, slightly higher than 1.24% end of June in terms of the September and June number in comparison. However, in general, the NPL ratio is quite healthy per se, at least for the published NPL numbers that they do have is relatively healthy. And the Bank of China, the main one of the main strength that they have in terms of comparing them with the local banks in the other local banks in China, either the 4 big banks, is that they have a strength in the FX related businesses. So in terms of FX related business, it means that anything that relates to FX transactions and also to overseas, international, domestic type of retail streams, companies that might have revenue stream coming in for overseas. And for China, the stimulus tailwind will actually still continue to push the bank's performance. And one of the main other key reasons is that the counter is going to give around 7% dividend yield, even if the current year-to-date rally. So this yield itself will actually be attractive to certain other investors in Singapore, for example, that if you want to diversify exposure into counter that have high dividend, and not only just the local 3 banks. Of course, local 3 banks have very good consistent performance as well. But if you're looking at also enjoying some growth story from China and you want a more dividend play, relatively supported by government-wise, Bank of China is one of the counters that definitely might fit that criteria itself. So next we have BYD. So BYD HYDD up 23%. Okay, so this particular one actually is a counter that have many interested investors. And one of the things that was mentioned just now by Vanessa was that it was very hard to invest in BYD in Hong Kong, because BYD Hong Kong, their trading price is at 240 per share, and their trading lot size is 500. So to trade it, you need 120k Hong Kong dollar, which is around 25k Sing. 20k plus 25k Sing, which is one of the reasons why Vanessa was mentioning that if you trade through SDR, you have a much lower capital outlay to start your engagement into investment into BYD if you want to try into one of the leading EV producers in the world, right? So the EV numbers that they have is very, very amazing, right? They have been a sales champion for the past 2 years, all right? They have broke 3 million annual sales target in 2023. And in January to October this year itself, they have already increased the growth of the sales by 36.49% year on year. They already sold 3.25 million vehicles this year from January to October. That's already more than the 3 million target that they hit for the past full year of numbers. So if you tell me a target of 20-25% when they hit, definitely I think they already outperform that particular sales target for the year. And likelihood they might continue to outpace the industry. However, do note that the squeeze in the margins will be impacting their profit margins in terms of BYD because of the price cuts across the industry. EV is facing very, very severe market competition. There's many companies coming in to China to do EV market, as well as the Euro side. They also have a lot of different counters, Euro government coming in with different measures to actually restrict or to put tariff on the China EV itself. All right, so even the US likelihood will then also impose tariff on the electric vehicle. This is one of the sectors that we definitely expect tariff to be imposed on itself. So generally, we're looking at how they actually continue. It's actually the company, whether they can control the R&D and SG&A expenses, and how they can actually boost their earnings through controlling that expenses in terms of when they expense it, how much to allocate or budget for the year ahead. Right. So for October itself, they have already produced and delivered 500,000 this new electric vehicles, right? So they have also managed to continuously 5 consecutive months of high in terms of the delivery output. So that one more point that people might mention is that that very strong outperformance right now, but also is that some people expect or believe that the BYD or China EVs are seeing a lot higher sales now to try to counteract or to try to front run the tariff that is expected coming in next year. So that's also one of the reasons that we see there might be certain headwinds in terms of performance-wise. All right. So in case of, let's say, everyone buy first and then they get delivered and end up when tariff get imposed, there's a sharp drop in terms of demand due to the sales or the price increase due to tariff. So that might be a concern per se for EV vehicles car makers. Okay. So for HSBC, you want the final counter, right? So HSHD, right? So it's up 13% for the year ahead, for this year, I mean. And for the year ahead, they're looking at preparing themselves for the lower interest rate environment, right? They're already reinvesting their structural hedges, which is for return of the cost of funds for them. And they have a maturity of 55 billion in 2024, coming in the second half, and 105 billion in 2025. So what this means is that when the bank can actually reprice the hedges of funds, right, they can actually look to lower the cost of funds that they have as a bank. And when if let's say we're saying that net interest margin is being reduced due to your interest rate environment dropping, the loan rate you can get from the lenders is dropping. So in terms of your revenue or your loan rate is dropping, but if you can cut the cost of funds, technically you can maintain a relatively healthy net interest margin, because your lending rate minus the cost of funds will be what your profit, right? So net interest margin. So if you can reduce the cost of funds, definitely it's positive for the company and for the bank. And they not only managed to have this particular strong point of reinvestment for the structural hedges, they also have very strong income growth in terms of the fee income. So they have their wealth income, like insurance, your bank insurance, your unit trust, your different type of funds itself, and also on transaction banking. So HSBC is one of the strongest in transaction banking in the world as well, across Europe, China, and even for the other region of the world. And in terms of the short-term catalyst for the share prices for HSBC is that they do have a 3 billion share buyback plan that's already been ongoing. So that might also support the share price of the bank itself. But for this counter, their dividend yield is a bit lower than Bank of China. It's expected to be 6% per se. But do note is that for Bank of China, the 7%, there is a 10% withholding tax due to it being also a China company. That they have a 10% withholding tax for dividend yield. So for HSBC, they will not be applied on them for the 10% withholding tax. Okay, so this is currently what we have, and I think I covered most of the content that I want to share for Hong Kong market. So we'll move the time. We have 10 minutes left for Q&A, so at least we can then answer more questions along the way. Okay, so one of the questions for Q&A: why is Alibaba preferred over Pinduoduo and JD.com in the SDR basket of shares? Okay, I think in terms of the general, if you ask me for e-commerce, retail e-commerce per se, of course, Pinduoduo and JD have been coming in very strongly and might even potentially overtake. We never know for Alibaba market share. But in terms of overall market share right now, in terms of the not only for retail but also for B2B, Alibaba is still the market leader. All right. And next thing is that Alibaba is still a lot more traded in terms of overall trading volume and investing. And in terms of diversification within the counter, of course, JD and Alibaba are both diversified, but Alibaba is more into AI, right? They have more exposure into AI, into technology exposure. JD is more towards the logistics side. They have more diversified into healthcare, into other segments. But if you tell me as a technological company itself, within technological sector exposure itself, I think Alibaba being included into the basket is more relevant than JD.com per se, and even Pinduoduo currently. But of course, we never know, right? So SGX might also collaborate to further bring in more counters from Hong Kong. If there is more demand that we do see from SDR's point of view for Hong Kong counters, there's always new counters that can be introduced, like how there were more Thailand counters introduced the second wave of SDR introduction, right? So next question we do have is for BOC, mentioned that the interest compression, what percentage of their business is non-interest income dependent and other investment products? I think we have to actually say what percentage of their business is non-interest income dependent, because I think you mean their fee income segment within the company itself. Majority of their income for most banks in China is still going to be on interest income, right? Majority. In terms of for Bank of China per se, and if you ask me in terms of non-interest income, the ratio and everything, It's not very high. I think maybe around 20 to 30%. But however, if you're telling me non-interest income is not dependent on it's not dependent on interest rate, I think not really true. It's also still somewhat relevant. All right, in terms of non-interest income, we're saying like fee income through other investment products and everything. But sometimes these other investment products will actually have a different level of demand due to interest rate. So interest rate is high, you actually put into fixed deposit, for example, right? Interest rate is high, you put into fixed deposit, you put into longer term deposits, which give you the better rates. But when interest rates start dropping, you actually look into other alternatives. So you look into alternative, which is the banks in terms of the non-interest income products, right? So the non-fixed deposit, you put into investments, you put into longer term structured products. So in terms of that, there is this push and pull effect between the interest rates in terms of the income that they will derive from interest income and also non-interest income. So I think when interest rates start dropping, you will see that the ratio of non-interest income sector be a lot larger and growing. And each bank, even for Singapore banks, can definitely have potential to grow further in that aspect in terms of the low interest rate environment. For Tencent, what is the dividend and is there dividend growth to look forward to? Okay, Tencent do give dividend, but the dividend is very, very, very low. So I did not mention it in terms of the one of the selling point. But I believe they give less than I think less than 1% of dividend, if I'm not wrong. In terms of the overall pricing. Let me just take a look. Yeah, I think it's less than 1%, right? In terms of the dividend. In terms of dividend growth, per se, Tencent, more of a growth story overall for capital growth and instead of dividend. They are still very highly reinvesting their income. I think they still have a lot of projects on hand. They still have a lot of avenues to try to monetize, to upgrade or grow their ongoing business. So they are unlikely that they will give out very high dividend in the short term, unless there's any diversifying of their business where they actually sell off some assets. Then in the aspect, if there's a very sharp increase in the one-time off type of cash they get on hand due to a sale of all the assets, they might consider giving out dividend at a higher level. But if not, usually I don't expect Tencent to give a high dividend in any time soon, right? Is HK or mainland BOC? It's actually the mainland BOC, but it's listed on Hong Kong as well. So it's the 3988. It's taking to 3988, not the Hong Kong, not the BOC Hong Kong, right? So it's a big BOC, the mainland one, but the listing in Hong Kong, all right? So this is the reference that we have for SDR with the Hong Kong listing. But now the one that we mentioned, the HBBD is actually the SGX listed SDRs. Okay, I hold a fair bit of Baba ADR under US platform under another brokerage. Can I convert this into SDR either brokerage or things so under CDB? Okay, this is a very good point. So basically, for conversion, it can be done, but we are doing it with Hong Kong. So if you are holding ADR, right, unless you can somehow change it to the Hong Kong listing one, we cannot convert the US ADR. Yeah. So we can convert the thing will come in for that. All right. So I hope that answered the question. Any other questions on the Hong Kong market or on the SDR per se? I do really feel the SDRs, the 5 that can trade Hong Kong, actually do a very big part to help in your investment portfolio diversifying choices. So I think it's there. I do see there are some questions on the chat itself. You can also put them in the Q&A if you have any, right?
Yeah, thanks everyone for your questions. I think adding on to Huan's point, right, about Tencent. So Tencent's dividend yield was at 0.8% as of October. So not very high as what he mentioned. But I think following on from what he said, one of the main propositions of Tencent is its wide trading range at around 2.6%. And it has strong year-to-date returns of around 53% as well. So investors may actually use it for more capital appreciation opportunities rather than for dividends. If you desire a regular stream of income, for example, we have stocks like HSBC and Bank of China that can offer higher dividend yields. So I think for HSBC, it offers dividend yields of more than 9%. And Bank of China is around 7% as well. So hope that helps.
Okay, so another thing is that for SDRs, if you are new to it, you want to find out more, we have a SGX website under the www.sgx.com/campaign/SDR. Also under the homepage of SGX, you can also see there's a SDR page itself where they actually explain more on how SDR work to see if you want to find out more before you invest into this SDR new instrument. All right. SDR itself also have a website from our poem site as well. So you can see which one you prefer to go into, but all of them will actually lead you to the similar information of SDRs itself. Okay. You can also even see the SDR on the price screener on SGX, one of the filters on the right-hand side. I think like if you move from instead of REITs and everything, you move on to the right side, there's a DRs. So it includes the SDRs of this price chart movement to actually see how the price has been moving and also to see the volume of trading. So we have been seeing quite good volume attraction for SDRs itself, and we believe that liquidity does help to provide certain investment choices for you in terms of investing into Hong Kong market through the Singapore avenue. All right, and holding your assets, holding these shares in SGX CDB. Okay. Okay, one question is, can I buy SDR from other trading platform? Yes, it's traded on SGX. So as long as you are going to be trading on SGX, technically you can trade on other platform and still get the SDR. Of course, as a staff of Phillip Securities, we will prefer, of course, if you do have an account with us and you trade through us. But the answer is yes for SDR trading on other platform. So Tencent shares held in Hong Kong, can it be converted to SDR? How do I do this? Okay. This one, you might want to actually reach out to our dealing team. All right, we help you to guide you along better, or you can look at the SGX website. All right, we want to consider what's the pros and cons of it before you actually activate the choice to do so. Can provide the link for SDR. Okay, let me just take a look. There is SDR link. I think my colleague will be posting them into the. Wait, my colleague will post them into the chat box. Right over here. Okay, so you can see more details on SDR on the link sent to the chat box itself. Right. Okay. I think Vanessa also answered the question on the Q&A tab itself for the Legion regarding your question on the SDRs itself.
Hey, Fanzi, this is Bernice. I think there's also another question on what are the fees for the SDRs. So maybe I'll just take that question. I think generally, trading in the SDRs is no different from like if you were trading any other stock on SGX. So if you are trading it, only the trading and clearing fees would apply on top of the usual brokerage commissions that the broker charges. I think we have received quite a bit of questions on whether the SDR charges an annual fee, right? Similar to like a ADR. Actually, no, there is no annual fee for the SDRs. The only other fee that is charged by the SDR issuer, which is Phillip in this case, on two instances. One, when you do a conversion of the SDR to underlying, there's an issuance or cancellation fee, or two, when there's a corporate action payment, right? So whenever there's a dividend payment, the SDR issuer will pass on the dividend proceeds to holders here. And in doing so, they will take a small fee of 1% of the dividend proceeds before passing on the remaining proceeds to holders here. So this is no different from today. If you were holding the Hong Kong shares or any other foreign shares directly, the broker does also charge a particular corporate action fee. So maybe I will just quickly also talk a bit about the liquidity. Some of you may have questions on how it's been trading so far, what's the liquidity like. So the SDRs have been launched, the Hong Kong ones have been launched and traded for about 2 weeks now. I think on a collective basis daily, we see about 1.5 million Sing dollars being traded across the 5 Hong Kong SDRs. The top traded names, as you can expect, are the tech names like Tencent. Tencent tends to be the top traded, and it rotates between Baba and BYD as well. The SDRs are all traded in Singapore dollars. So if you look at the price page or the order book that you have market depth, right, they are traded at quite good spreads of between 1 to 2 ticks during the overlapping hours with Hong Kong. Of course, when Hong Kong closes at 4 o'clock, between 4 to 5, the SDRs do continue to trade because it trades on Singapore market during our market days and hours. And there you would still continue to see the bid and ask quotes in the order book as well.
All right, Bernice, thanks for sharing on the stats itself. Also, I think if you are still interested, actually we are reaching the end of the session, but you can still reach out to us, either the dealing team, either the SDR through the website that was mentioned in the chat box as well. All right, so there are a lot of information that is shared on SDRs in terms of the counters, in terms of the numbers itself on the SGX website. Okay, if not, you can also reach out to your trading rep to know more. All right, so let's thank everyone for joining us this afternoon, and hope it has been insightful for you to see and if you want to consider SDR as a point of investment choice for investment portfolio. All right, so thanks everyone, and have a nice weekend ahead.
Thanks,
Thank you, Bernice and
everyone.
Vanessa.
Thank you.
Thank you. Bye.
Thanks. Bye.